Hello. In this tutorial, we're going to work through two specific aggregate demand shocks. We're going to work through a decline in wealth that occurs because of the fall in housing prices and also a decline in taxes. What I've got here is a list similar to the one that we walked through for short-run aggregate supply shocks, just to give you the steps that'll help you analyze any aggregate demand shocks. Okay? So in these first two steps, we're tracing out the short-run effect by explaining the effect of the shock on aggregate demand, talk specifically about which component of spending changes because of that shock and why. Always tell me why that happens. And then explain why producers would change their production because of that shock, and why producers make decisions in response to an aggregate demand shock has everything to do with the price change. Okay? So the aggregate demand shock is going to change prices, and then because of sticky wages and prices, that price change will give firms an incentive to produce more or less. Okay? Then talking about the transition from the short run to the long run is all about price expectations changing and therefore leading to wage and price adjustment. So up here we've got sticky wages and prices, and then in the transition, wages and prices begin to adjust to the shock. In the end, the prices will have fully adjusted to the shock, and you want to then tell me what that long-run impact of the shock is. When we say the long-run impact, we mean that the long-run impact on prices, output, and employment. Now, employment is something we haven't yet talked about in these slides, but you'll remember that when we characterize the macroeconomy, we always talk about these three major things. And since employment moves with output, it's easy to add into the analysis. Okay, let's move on. So let's look at the case when housing prices decline. And of course, this was one of the major shocks that occurred during the Great Recession. We have potential output, long-run aggregate supply, short-run aggregate supply, aggregate demand, and we're starting off here at potential at point A. So when housing prices fall, this leads to a decline in household wealth. And when household wealth declines, consumption goes down. So essentially what's happening here is because households have lost some of their asset, their major asset has lost some value, they feel like they need to make up the loss in wealth and save more to rebuild their wealth and spend less. So this shifts the aggregate demand curve down and to the left. The decline in consumption spending. And the economy moves from here to A to B. Firms respond to the decline in spending, and that's shown by the movement along the short-run aggregate supply curve. How firms know to respond to this decline in spending is part because prices are going down. Okay? The decline in spending lowers prices, and this price decline leads firms to produce less. In the case when wages are sticky, then the decline in prices means that firms are getting less revenue per unit, but their costs aren't falling as much. And so per unit profit declines, and this gives an incentive for firms. This tells firms to produce less. In the case when prices are sticky, what's happened here is that this price decline has occurred because some firms are changing their prices, but other firms with high menu costs don't adjust their prices. Those firms that are keeping their prices relatively high are producing less. They're getting less market share. So the sticky price firms choose to produce less. So in the short run, the aggregate demand shock takes us from point A to point B. People are spending less because of the decline in wealth, and firms are producing less because the lower prices in combination with sticky wages and or sticky prices give them an incentive to produce less. So the short run impact of this shock is that output has gone down. We've fallen below potential output. Prices have fallen. And because firms are producing less, they're hiring less, employment has gone down, which is the same thing as saying unemployment has risen. Okay, so the shock has helped create a recession, lower prices. Let's move on and talk about the transition. And as you recall, the transition is going to be all about price expectation adjustment. Now let's redraw the short run impact. In the short run, we had a negative aggregate demand shock, moving the economy from A to B, and at this point B, in the short run situation, output has fallen below potential. And when output is below potential, labor markets are loose. There's a lot of slack in the labor market. People are unemployed. Unemployment has gone up. And firms are producing below their efficient capacity. And these things, in combination with people observing that the prices are indeed falling, leads to price expectations declining. People know that the loose labor market is likely going to push down wages eventually. Wages will become unsticky. The excess capacity puts a downward pressure on prices, and so people expect prices to go down. As price expectations go down, workers will accept lower wages. Their bargaining power is lower because there's higher unemployment. And so with the decline in price expectations, wages and prices begin to become unstuck. Wages begin to adjust downward. And eventually these firms that kept their prices high, they will begin to reevaluate and to raise and to lower their prices. So eventually firms lower prices. That is, those firms that had kept the prices sticky will begin to lower them. And these combinations of events mean that the short-run aggregate supply curve is going to shift down and to the right. What that is signaling is now firms will be able to produce more at lower prices. The decline in prices and the decline in wages allows firms to produce more at lower prices. So in the long run, we end up here at C. The long run impact of this shock, the long run impact of the housing price decline, is that we return to potential output. So we return to the natural rate of unemployment. We return to the natural rate of unemployment. Okay. And we do so, though, at a lower price. Prices are lower. Lower than they were when we started off here at A. We have lower prices, but I've returned to potential output and returned to the natural rate of unemployment. Okay, now let's take a look at another shock, a positive aggregate demand shock this time, when taxes decline. Will get us set up. So in this scenario, we're looking at, as I said, a positive aggregate demand shock. Let's work through our methodology. We want to explain the impact of this shock on spending. Right? So when taxes go down, people have more take-home pay. Right? And we call that take-home pay disposable income. It is the income that people have at their disposal to spend. So take-home pay goes up, and this allows people to spend more, and private savings is going to go up as well. So households can spend more and save more. Now, of course, public savings is going down. But households with the tax cut can spend more and save more. This increase in spending shifts the aggregate demand curve to the right. A to B. And the higher spending leads to higher prices. Why are firms willing to produce more? So people want to buy more. Why are firms willing to produce more? Because the higher prices give firms an incentive to do so. In the sticky wage scenario, when wages are sticky, the higher price means that revenue per unit has gone up. With sticky wages, though, costs per unit don't go up as much. So that means that profit per unit has increased. And this gives the incentive to firms to produce more. Now, if what's more relevant is that prices are sticky, what's going on here is that this price increase has been driven by some firms raising their prices, while other firms have kept their prices sticky, haven't raised their prices as much, or maybe not at all. So those sticky price firms, right, they're getting a bigger share of the market. Their prices are lower relative to others, so these sticky price firms produce more. So in the short run, this aggregate demand shock, because of sticky wages or sticky prices, leads firms to produce more. So the short run impact of the shock is that we get more output, we have gone above potential, and Firms are doing that. They're getting more output by hiring more people. So employment is going up. Unemployment is going down. And prices have gone up. So in the short run, higher output, higher prices, lower unemployment. Okay, so that's the short run impact of the shock being the tax decline. Let's redraw that and now talk about the transition. As you know, the transition is going to be all about price expectations changing and prices and wages becoming unsticky. So we had a tax decline, which increased aggregate demand in the short run. In the short run, we have higher output, higher prices, and at B, we have gone above potential output. That means that labor markets are tight. Unemployment is low. There's not a lot of spare workers because demand for them is high. Firms are producing above their most efficient point. And both of these facts mean that eventually wages and prices are going to adjust upwards. People have observed a higher price. They observe that labor markets are tight, output is high, and so price expectations increase. We know that this is going to shift the short-run aggregate supply curve. The higher price expectations, in combination with these factors here, the tight markets, are going to eventually lead prices to adjust upwards. Those firms that have kept their prices sticky are now facing even higher costs and expectations that their competitors will be raising their prices even more. So now they find it in their benefit to also raise prices. Wages also begin to adjust upward as those tight labor markets force firms to compete by way of higher wages to hire workers. And so these combination of factors means that the short-run aggregate supply curve shifts up and to the left, or in other words, the higher prices and wages mean that firms are only willing to produce more at higher prices. So we end up here at point C. So the long-run impact of the shock is that we return to potential. That means we return to the natural rate of unemployment. But in the end, prices are higher. So the tax decline gives us a temporary boom. It also sets in motion the incentives to increase wages and prices, which nullifies the initial boom, returns us to potential at a higher price level. Okay, so we've walked through two examples of aggregate demand shocks. You have from another lesson a list of the major aggregate demand shocks, the major shocks that affect consumption, investment, net exports, and of course government spending as well as a major aggregate demand shock. So it would be a good idea to go back and to make sure you can work with all of those shocks and understand how to use aggregate supply and aggregate demand to walk through the short run and the long run impact of those shocks. Thanks so much, and as always, enjoy.